Welcome everyone again to Abt Associates webinar series, Reimagining Private Capital for SDGs, and specifically to our second webinar in the series, Challenges to Mobilizing Private Capital in a Recessionary World. Abt Associates is a global research and consulting firm established in 1965, and we work across a multitude of sectors. I'm audible, right?
Yes.
I'm getting a bit of background. Okay, thank you. So Abt Associates is a global research and consulting firm. We work across a multitude of sectors such as global health, climate change, and inclusive economic growth. And in all of these, private capital plays a pivotal role in our ability to achieve the developmental goals. And as such, this conversation is very relevant and dear to us and our ecosystem partners, many of whom have joined this conversation today with us. Quick WebEx housekeeping before we start. All participants except the panelists will be muted through the duration of the webinar. But if you have any technical difficulties, feel free to use the chat window on the bottom right-hand corner to let us know. The webinar is being recorded and will be posted at a later date on the webinar series page, where the previous webinars and all the future webinars will be posted as well. In terms of the agenda, we'll start with a brief overview on the webinar series and the webinar for today to set the context, and have a round of introductions among the panelists where they can give you a brief introduction about themselves and their organization's work in private capital. And then we'll dive right into the panel discussions. We have budgeted the last close to 5 to 10 minutes for audience Q&A. And thank you to all the participants who send us their questions ahead of time during the registrations. That have been really helpful. But if you have any further questions during the duration of the webinar, again, please feel free to send them over to us through the chat window, and we'll aggregate and address those during the Q&A session. Great. With that, we'll move on to the webinar overview. In our inaugural webinar early in April, we discussed in detail the SDG financing gap and the need to address that through private capital. The recording of the webinar is available on our webinar series page, and I'll urge each of you to go visit the page. But as a quick overview, currently it's estimated that there's about $2.5 trillion annual gap in achieving SDGs by 2030. And it seems unattainable. But even across the next decade or so, SDG achievement requires significant additional funding, and private capital would need to play a pivotal role. And this is well acknowledged by both public and private sector stakeholders. And in light of that, private capital over the last decade has been significantly growing. Impact investing, which is just a subset of private capital for SDGs, alone is now estimated to be over $1 trillion in assets. However, a lot of this growth has been skewed towards certain sectors and geographies. Geographically, the Global Impact Investing Network estimates that over 90% of impact investing assets are headquartered in the global north, having an impact on the ability to diversify geographically in emerging markets. And in terms of sectors, financial services and energy alone constitute a lion's share of impact investing. Now, to mobilize private capital at scale towards SDGs, it's important to bring in diversity, both in terms of sectors and geographies. And this should be in line with the United Nations stated principle of leaving no one behind as we strive towards achieving SDGs. In that context, we believe that the next phase of private capital growth should focus on a diversity across the investment process, both in terms of supporting diverse entrepreneurs and diverse fund managers and investment professionals. Sectoral diversification, investing in sectors such as WASH, healthcare, affordable housing, climate adaptation, etc. And finally, on the use of innovative financing tools such as blended finance to de-risk private capital mobilization into these sectors. Abt Associates webinar series, Reimagining Private Capital for SDGs, is a series of 6 to 7 webinars that will build further on these themes. Our inaugural webinar, which happened in early April, discussed in detail the opportunities and trends in investing in these underinvested sectors and geographies. And today's webinar will be discussing the risks and challenges in these investments. Private investments in emerging markets do have inherent risks associated with the early stage business models. And impact investing further has systemic political risks of investing in social sectors. The COVID-19 pandemic and the concurrent global political crisis that we are witnessing, such as the Russian invasion of Ukraine, has further exposed the fault lines and stressed the system. The World Bank currently predicts that global economic growth would slow down to about 1.7% in 2023, which, along with the global increasing interest rate environment, is expected to exacerbate the debt distress that emerging markets enterprises face and their access to capital. So any conversation on mobilizing additional private capital or private capital at scale towards SDGs in emerging markets should therefore discuss these risks and challenges at the very outset. And that's precisely what we will do today. I'm Arun Ashok, strategic lead for private capital and impact investing at Abt Associates, and I've been an impact investor myself over the last 15 years. And today I'm joined by a diverse set of investment and risk professionals with extensive careers in the development finance. And we are really looking forward to their insights through this webinar. I'll turn it over to them for a brief introduction about themselves and their organization's work in private capital. And we'll go in alphabetical order as we see on the screen right here. So Amy, if I may start with you.
Hi, thanks so much, Arun, for the introduction and inviting me to be on this panel today. So I'm Amy. I'm based out of New York, and I lead private credits at Blue Earth Capital. Blue Earth Capital is an independent investment manager that is solely focused on delivering impact to those most in need, which includes the planet as well as the people. We are a spin-out out of Partners Group, a large global asset manager, and formerly you may have heard of us as PG Impact Investments. As of today, we are Blue Earth Capital. We run about $1 billion across diversified investment strategies in private credit, private equity, as well as funds and co-investments. While the historical footprint has largely been in the emerging markets, we also do have footprint in developed markets as well. I'm very happy to be here.
Thank you, Amy. Christian, over to you. And it'll be great to hear from you, Christian, both about Bamboo and Kulana's work.
Thank you, Arun. Thank you for inviting me to the conference, to this webinar, and giving me the opportunity. My name is Christian Rummer. I am a senior investment advisor for Bamboo Capital. Been with Bamboo Capital for over 10 years. Bamboo is an impact investment company, initially a spin-off of Blue Orchard, investing primarily in private equity. Over the past years, we diversified, managing private debt and private equity funds. The private debt funds are all blended funds with international organizations from UN, such as IFAD or UNCDF, as well as managing equity funds for startup financing or venture financing in Africa, both in a very, very diversified way, as well as with a specialty on energy. At the same time, I also created a company called Kulana, which is a company that digitizes financial institutions, primarily traditional financial institutions in developing countries, with the core concept that these institutions are on the one side challenged by fintechs and by their own inefficiencies, but on the other hand, have the benefits of long-term client relationships and could be a great tool for impact investors if leveraged in the right way. So we are basically digitizing developing countries' financial institutions and make them ready to partner for investments. Thank you.
Thank you, Christian. Injiri, over to you.
All right, thank you. It's a pleasure to be part of this webinar. My name is Njeri Kirumbi. I'm the Regional Director for Africa at Water Equity. So Water Equity is an impact asset management company with an exclusive focus on water and sanitation. We do this by providing debt financing to financial institutions to own land to the water and sanitation segment. We also provide equity financing to enterprises in the water and sanitation value chain, as well as investing in small to mid-market infrastructure projects, mostly around PPPs or investment platforms. Overall, our main focus is really to provide funding towards low income and low middle income countries. Thank you.
Thank you, Njeri. And last but not least, Pavel, over to you.
Thank you, Aaron. Hello, everyone, and thank you for having me here. I'm Pavel Blitsky. I'm Director of Hedging Services at MFX Solutions. MFX Solutions is a hedging facility specializing in providing a hedging transaction for impact investors in emerging frontier markets. We've been here for the last 14 years with over 5 billion loans hedged. Thank you.
Thank you. I'll stop sharing the screen so that we can then dive right into the discussions. Great. And Amy, if I may start with you, we all know that Blue Earth Capital is one of the largest asset managers in the impact investing space. And by virtue of that, you have very diversified investment strategies from fund of funds to equity to debt. I think it'll be interesting to very briefly understand sort of the nuances of risk assessment and mitigation that you have across different strategies, but a bit more in detail probably about your private credit strategy. When you look at emerging markets investments, what are some of the key risks that you evaluate and how do you mitigate those?
Thanks for that. And thanks for that note around the diversification of our strategy. I think part of the way we look at risk management as a whole really comes from that diversified strategy, which is that we think we're quite unique in that we're one of the only institutional specialist investors that run that end-to-end active model, which allows us to be able to deploy different solutions to enterprises in different parts of their growth cycle, different parts of the market cycle, et cetera, from credit to fund to equity. And all of this comes from a very core thesis that relative value needs to underpin each of these strategic and deal-by-deal decisions. So the first risk management lens comes from that complementary use of equity versus debt. And at this point right now, with equity markets the way they are, quite uncertain, we actually think it's a really interesting time to be able to deploy credit as a result of that. But also another more higher level comment is that we think that investing in credit in emerging markets itself is a way to actually also be risk adjusted in risk management. Because from our perspective, credit is an asset class that is naturally defensive. Not only does it have a structured return and ensure that there's downside protection with covenants and milestone tranches, which I'll speak more about, it's a way to ensure that in a rather volatile market, there's a way out, if you will, to get our capital back. Furthermore, by definition, we think that impact investing as well is naturally defensive and risk mitigate. As impact, what are we trying to do? We're trying to actually support sectors which are essential to human development outcomes in areas such as health, finding places for people to live. So no matter what, even if we're in recessionary times, people will still need to look after their health, find these places to live. So these businesses which serve the basic needs, we feel will continue to grow irrespective of market conditions and headwinds. But going to the specific question, which is around the credit portfolio level, ensuring appropriate diversification is risk mitigant number one. We want to make sure we're very diversified across sectors, geographies, and assets. You mentioned earlier about the types of financing and the overall market conditions for energy and financial inclusion takes up a bulk of that capital. It's true, those are very financeable sectors, and we do have quite a bit of exposure in those markets. But within finance, we want to make sure that we can create subsectors around specialty finance, different business models in a way that can counterweight and balance different dimensions within specific sectors. So if you look at our portfolio, we have about 60% of our portfolio addressing basic needs and sustainable growth, and about at max 40% more focused on the environment. The second piece of diversification and risk focuses on the country because emerging markets naturally a little bit more volatile. So we deploy a country risk framework where we manage the exposure based off the rating and the business climate of every country. This leads us to roughly have about 40% each in the Americas and Asia and about 20% in Africa. But the title of this panel is about what's happening in the recessionary environment. And it's true today, the market conditions are volatile and rates are rising. So what we want to do is also make sure that we strive to balance currency considerations. And Pavel can speak much more about currency a little bit later, but from our perspective, we need to ensure that all of our exposures are fully hedged to USD. We'll also look and complete full look-throughs of the business cash flows to ensure that there's appropriate management of Forex. And then lastly, as I alluded to earlier, individual transactions are structured with downside protection in mind. We maintain strong collateral via over-collateralization. We have on average probably about 5 financial covenants per deal, and we also set milestones where we phase out our tranching. So this focus has allowed us to achieve an NPL level that we're pretty proud of, just about 0.5 since inception, so over the last 7 years, despite COVID. And on the flip side of that NPL, we've also delivered about a 10% return to our investors. So also pretty happy about what we've been able to do there as well.
Thank you, Amy. You already answered my follow-up question, which was, what are you specifically mitigating around current recessionary environment? But also interesting to hear about your views on the customer segment and their needs, which are more consistent regardless of the global economy. Would it be fair to assume that the diversification that you were talking about within financial services and otherwise sectorally, and that stripe hasn't stopped given the tough environment we are in, or probably you're diversifying more?
We're diversifying more. It's not stopped at all. In fact, we're finding a greater volume and a greater quality of opportunities as we're seeing there are folks out there that would have naturally gone to perhaps banks or been able to raise equity. And given the uncertainty and the retrenchment being faced by those banks or those other equity providers, some of these entities are rather curious about the offerings that we have, which can be structured in a more collaborative and creative fashion. So what we're seeing is actually our pipeline right now, healthcare is surprisingly a large portion of that bucket. Another area that's a bit higher is just around general SMEs that are looking to expand in really bespoke areas where the currency pairs are really hard currency, USD or Euro in nature, and that we haven't seen that as much historically.
Great. Thank you, Amy. Christian, coming to you, you've come from a background of mainstream investment and risk management and have been with impact investing early on with Bamboo Capital. And from your vantage point, having seen the industry sort of evolve over time from just microfinance to larger financial services and other sectors, what are some of the challenges and risks or rather, what are the challenges in mobilizing private capital at scale for these diversified investment mandates, like really investing into the least developed countries or sectors really outside of financial services and clean energy?
Right. Thank you, Arun. And I was listening to Amy as she was describing the investment strategy and the returns she's achieving, as well as the NPLs. Congratulations for that, because it's not the same level that we see here. We see a little bit of a challenge, specifically when it comes to the size of investments. Yeah, because if you are engaging as an international investor, you do need to go for a specific minimum size, let's say $250,000 or even more, $800,000 in another fund. We have another fund which doesn't do anything below $1 million. In this way, you already put yourself into a bucket of investees that is already challenging, in the sense that this usually deals with capex investments, long-term loans for companies to whom you have very little relationship. Usually, if you talk about a banking relationship that builds up over a decade, where the entrepreneur starts with a small loan of $1,000 and then goes up to $50,000, goes up to $100,000. In this way, you create trust between the relationship between the borrower and the lender, which very often you don't have in the impact investment space. You get shown a transaction that you either source yourself or get through a broker or through other sources, and those transactions usually revolutionize the company, yeah, in doubling the output, tripling, quadrupling the output, while also taking significant risks. We see that as a challenge for standard debt investments, because your upside, well, you're protected with covenants, of course, you are protected with collateral, but your upside is still limited in the sense of if everything goes well, you just get your money back. You have no upside participation unless you go into a venture debt or you go into a mezzanine financing, so that you can actually offer at attractive rates while at the same time benefit from an upside. At this stage, a traditional term loan, amortizable term loan with a grace period is very limited on your ability, or is not necessarily in line with the risk profile that this company has, unless you go into very short-term trade finance transactions where this is better possible. So we still are struggling a little bit with these risks here. We're still struggling a little bit with a combined approach where we say, okay, there are transactions such as FIs, MFIs, where you lend to in a very professional level, where you have your covenants, where you have your experienced borrowers, and then you combine that strategically with a couple of less developed SMEs or SMEs in less developed countries, where you are attractive on the price, which is still a challenge because rates in these countries did not follow yet the market in the US, and even the IMF criticized this quite a lot, that rates are kept artificially low in some of the developing countries, but at least you can combine it to have a approach over time. It's not ideal, but it's working the way we're currently doing it.
Thank you, Christian. I think it might be useful to give the participants the nuance between different kinds of impact investors. Blue Earth Capital that Amy represents, as I mentioned, is a large asset owner, and by virtue of that, invest in much larger ticket size transactions. Christian, representing Bamboo, have much smaller transactions and smaller deals that we work on, and that has an impact on sort of the risk assessment and the nature of business models that we invest in. Just wanted to clarify that for the participants as well. But Christian, as a follow-up, and thank you for that sobering and realistic perspective, and that's precisely the reason we had this conversation today. From Culana's experience working with more local banks, how have they sort of adapted to this changing environment, both in terms of the funding that they are receiving globally and how they've evolved to manage the risk locally in their investments?
Thank you, Arun. I do believe that local banks have large scale the wrong reputation, yeah? As being very reluctant, as being very risk averse, structured, and only finance if there's 150% of collateral coverage and so on, as well as not necessarily being very efficient in their processes. And I think has maybe been the case for the last 10, 15 years, but it's changing. Actually, I do believe that the local banks do offer a significant benefit to international investors, because what local banks have is they have proximity to clients. Customer centricity is basically their thing. Based on the experience of local loan officers, investment managers, and so on, they also have an ideal position to assess risk and subsequently manage risks. Because if I have my team by Bamboo based in Nairobi and I have to do a workout in Rwanda, I'm already $2,000 travel expenses away from the client. Yeah? To get there already costs me money. A local bank would be much closer. A local bank, so therefore a local bank is better in risk assessment and in risk management. The problem they have is they're not strong on risk taking, because that takes equity. So the goal that we are striving with here with Culana, with an SME lending fund, is actually to go into the banks and co-lend. Let the bank originate, let the bank manage, let the bank collect, but co-finance the loan, not in the traditional way where you just do balance sheet lending to the bank, because that's not necessarily helpful, but offering a risk participation so they get around the capital requirements and offer term funding. Both things are short in supply for these banks. If we can combine that, they're working on a pilot fund the second half of this year in East African country for about a $10 million loan portfolio. If that works, that you can really attractively co-lend, then you can at least for the smaller loans. Again, I said the 250,000 to $2 million loans. You can start creating a wave of impact investment that really gets to the goal without all the downsides that we have currently.
Great, thank you, Christian. And I think that's well aligned with the development world's most relevant priority right now of localization. So bringing in more local partners to actively take a role in these objectives. Thank you. Njeri, coming over to you now. I remember reading an article by one of your colleagues from water.org on WASH being water sanitation and hygiene being categorized as a consumption loan as opposed to a productive loan such as microfinance or SME, agri-finance, etc., and how that unduly sort of impacts risk considerations and investments and impacts private capital mobilization. It'll be great to hear from you, your experience and the firm's experience in terms of investment risk assessment and management within WASH and how that sort of compares with traditional productive loans.
All right, thank you for your question. And that's actually one of the main challenges that we face in the region and also globally. Really the perceived risk that water and sanitation loans is more of a consumption loan because technically when you're talking to the financial institutions, they would look at the borrower and say, you know, we can't go and repossess the toilet or the water tank, for example. So this is where water.org comes in. Now, water.org is a sister company of Water Equity. It's been there for over 30 years now. The main role is really to provide a portfolio of smart solutions that really break down the financial barriers between people living in poverty and accessing safe water and sanitation. So this is achieved by working with the financial institutions by providing them with technical assistance, could be in form of resources or also consulting expertise to these organizations, training them to really equip them to be able to on lend to this particular segment. Now, Water Equity was actually born out of this because what we found is most, if not all, of the water.org partner institutions would say, all right, you've worked with us, you have shown us how to lend to this segment, how to assess this perceived risk, etc. But then we still need funding. We need dedicated funding to be able to focus on this segment. So Water Equity was born out of this a couple of years ago. And over time, we have really worked closely with water.org to either pick up the partner institutions that they have worked with over the years to be able to grow this portfolio or form a dedicated product. Or then alternatively, from now Water Equity side, we would go out there, talk to financial institutions, especially the banks, and introduce them to water.org. So it's usually, I would say, a mutual relationship in the sense that we don't just focus on the funding side, you know, and leave the financial institution to grow the portfolio. We like to walk the path with them, and it could either be fast in terms of technical assistance, developing this portfolio, then funding, or the other way around.
Thank you, Njeri. I think it'll be helpful for the participants to better understand the role that water.org plays, the technical assistance that you mentioned, and what are some of the examples to provide that capacity strengthening to mitigate the investment risks?
Yeah. So the technical assistance mostly focuses on market research, understanding the demand that's out there because it's different for each of the markets. As much as water and sanitation really sounds like such a focused sector, there are different solutions and types of products that are out there on ground. It also does quite a lot in terms of training the loan officers or even the management team in the financial institutions. But most importantly, we also try to make sure that we're working with key industry players. So this could be either microfinance associations, bank associations, more outside the financial segment, we would then look out for the water and sanitation associations or even key government stakeholders. So through these interactions or initiatives, it really helps to build the pipeline, not just for water equity. Actually, one important thing is Water.org can work with any other lender, I would say, out there, because their work is really to form the framework, the whole foundation of this particular segment on water and sanitation.
Great, that's really interesting to hear. Thank you, Jerry. And Paul, finally turning the spotlight on you now. MFX, I believe, is really addressing a fundamental need in impact investing space, which is currency hedging. For the longest time, currency hedging has been unaffordable for emerging markets investors in general, but more so for impact investors who have smaller ticket sizes. So you came out with an affordable product, and as we understand, evolved from just focusing on microfinance to various other sectors over the years. We would assume that your sort of risk and pricing considerations are more at a country level than sectorally, but it'll still be great to understand from you as to how the product has evolved as you diversified sectorally and of course geographically as well over the years. Pavel, I think you're on mute.
Sorry about that. Thank you, Arun. And it was around 14 years ago when MFX was set up to provide hedging solutions specifically for microfinance sector, which faced a few problems like access to banks, access to hedging transactions, and high collateral burden. When MFX was set up, we provided the access to hedging and relieve the high collateral. And when we're looking at the transactions, we started with microfinance, and over the last 10 years, this model was very successful. We hedged over 5 million in loans, and we saw that there's a need also in other impact sectors like housing and solar when faced with similar reasons. So when we look at the transactions, we look at the country, and when we work with our clients, we work on the detailed transactions, starting with the structuring, starting with knowing the details of the investment, and the tenor of the investment. Our clients are equal, so we charge the same fee for everyone. So we're focusing some of the investments as tenors, as you said, countries, and then we start structuring and trying to get the best possible transaction to hedge the exposure of the underlying investment. As I said, we moved from microfinance, trying to expand the scope to SME, housing, and energy, which are way bigger markets and a little bit more price sensitive, a little bit longer tenors, which can be challenging in structuring in terms of a price sensitivity and also as a collateral. There's also some challenges in structuring the receivables, which are unequal or not scheduled as it is with a microfinance and a debt investment. But as I said, we've been very successful with our model over the last 10 years. We have over 150 clients and 5 billion loans hedged so far.
Thank you, Paul. And as you mentioned as well, one of the key consideration in hedging is pricing, and that's the reason it was unaffordable for the longest time. How has the current environment, the rising interest rates, sort of impacted your ability to continue being affordable for impact investors? And have you been able to maybe structure any new products or pricing strategies to mitigate that?
That's a very good question. The market has been volatile for a long time, and it's been challenging. And being affordable, the hedging it's all about the interest rates, and the hedging is a differential between two interest rates, between local currency and hard currency. So in terms of affordable, our fee is same for everyone. Is it a 50,000 loan or 5 million loan or 50 million loan? We charge the same fee. Then we look at the markets and we look how expensive is the market. And so what we're trying to do for the specifics, countries which have a persistent inflation like Ghana, countries which are, let's say, facing some internal issues, shortage of dollars like Nigeria, there are different issues here. Countries which are fighting inflations, like countries in Latin America, Brazil, Colombia, Mexico. So there are different challenges. So what we're trying to do when we look at the developments in the country, and we look how the cost of hedges presenting itself, we're trying to structure transactions looking at, let's say, give the example of Brazil, when there's a chance that this hiking cycle might come to an end, and there might be some good idea to use the floating rates. Or we look at the markets when in the super volatile times and inflation being all over the world, spiking to the highs, we see that the curve, we see different curves and inversion of the curve, which we can use in our advantage. And we can talk to our clients, we can talk about the investments and see what's the best part of the curve or the best part of the market. Is it the longer transaction, which is cheaper than the shorter? So we try to use the market, in our advantage. Is it affordable? From our side, we believe it is, because we have a fixed fee and we charge the same to everyone. From the market perspective, it's expensive. The interest rate differential. Yes, if the Fed is still hiking the rates and the local currency hiking the rates, so we're looking at this differential. There are countries still in Latin America, like Honduras and Guatemala, which I think are very, very affordable. Same as Asia, in India and Indonesia, which we think it's affordable in the countries which this interest rate differential, the cost of hedge is super high. We're trying to structure different ways, maybe some rolling transactions, maybe partial transactions, take the market conditions and consider it in our advantage, using the floating rates or different tenders to do it. But sometimes it's just too expensive. But from the affordability point of view, we charge everyone the same, then look at the market and see what the market offers us.
Thank you, Paul. I think fully understand that it's a country to country, very, very, very different scenarios. We'll have a few more questions among the panelists before we open up for audience Q&A, which, as I mentioned, we already have some questions that we have received during the registration, and I also see one odd in the chat as well. Amy and Christian, I have a question for you regarding the use of technology in risk management. And Amy, if I could start with you, trying to understand how some of your investees like Neo Growth or Tugende have used technology in sort of their own better risk management, but also from your perspective as an investor, what role has technology played in your sort of risk strategy?
From a overall process, I think there are tech businesses, there are tech-enabled businesses, and very brick-and-mortar businesses. The reality is the bulk of what we invest in is a bit more brick-and-mortar rather than a pure technology business. And where there is technology, such as you mentioned in Neo Growth, which actually sits in our equity portfolio, we've got an equity co-investment with Neo Growth there. It's a business model where we would look at the fundamentals being rather brick and mortar, and they're using technology to hopefully leapfrog in a way to increase efficiencies with the processing times or the data analytics, etc. We don't claim to be really strong on the technology side, actually. And personally, individually, as a platform, the way we look at technology and risk management is just by active, proactive portfolio management, in which case we have some interesting and so far good third-party advisors and platforms in which we leverage.
Great, thank you, Amy. And Christian, you mentioned about Culana's role sort of in the SME fund and co-investing with the banks, but we understand Culana also has a platform or a technology platform to manage loans. It'll be great to understand how that sort of augments the risk framework of local financial institutions.
Right. It was interesting because I recently attended a conference in Rwanda called the Inclusive FinTech Forum, where the conference was all about how technology can leverage lending, how you can do more better lending with technology. And I think the fundamental point that nobody can forget is that a loan is still a question of trust. Yeah? I give you money, you promise to pay me back. And around that is a lot of understanding of the business, a lot of understanding of the value of the relationship between the borrower and the lender, and that's still the underlying assumption. Of course, technology can help, and technology can help in structuring the information, in, for example, making sure that the information is socialized within an institution. Very often you see that a relationship manager has a head full of information, a head full of decades of experience in dealing with specific clients, but it's not socialized inside the institution. Making that information available, assessing that information, deriving from that best practices about how to analyze a loan in a specific sector, how to structure a loan for a specific sector, how to measure the covenants and so on. There's a lot that technology can support, as long as you have somebody who really fundamentally understands the loan, understands the business, and can, of course, interfere in the business or interfere in the payment plan if there are any issues occurring. Yeah? This is, I think, that's the essential part, to have a technology in place that can quickly react to early warning signals. An early warning signal is not a non-payment of a loan. That's a problem. Huh? An early warning signal is an early indication that certain covenants are heading towards default. If you can make that available with technology, I think you have a starting point to really interact with the borrowers quickly, making sure that even if there are difficulties, they are supported and can manage through their loan. I think that's essential, where technology can really help, can leverage. But again, the underlying idea is still there is a thorough understanding of lending business necessary.
That's an interesting take, Christian, and I fully agree that there are several great investment professionals in a lot of these local financial institutions, but not necessarily that their sort of knowledge and expertise is democratized across the organization, and technology can play a key role there. But following up on that,
me growing up in Europe, I used socialize instead of democratize. But I think the same.
Indeed. But maybe, Paul, linked to that, the question I had for you was, we understand that MFX also provides capacity strengthening solutions for MSMEs and local financial institutions to, similar to what Christian mentioned, sort of strengthening their risk and credit underwriting processes. What have been some of the key areas of, key gaps that you have identified, and areas of intervention that you have sort of devolved? Sorry, Pavel, you're on mute again.
Sorry about that. Yes, at MFX, we provide education to grow the hedging solutions, and it's linked to education. So we start with education, and most of our clients, most other funds coming to us, are not experts in hedging. So we see that, and we want to address that. So we offer to all our clients free education, and we see that the structuring and looking at the investment. And we understand that there is an investment, and then the fund is focused on the investment, and we understand that we are here to help protect this investment and help to disperse the loan, which is we start with education and see how we can help. So all the details of the investments, we're trying to find out all the needs, and then discuss through the series of webinars or series of meetings, and when we discuss, we find out what are the needs, and trying to pass the knowledge on, how the transaction works, what transaction we can use to help disperse it. As I said, let's say the perfect example is if you have a loan, let's say in Brazil, and there's some struggles, what we're going to do, the rates are high, what we can do, we go through the markets, on specific markets, we focus on specific markets and see how we can structure it in a way to help the investor disperse on the way the road and make this investment, like maybe using a floating rate or maybe using different tenors for this transaction. So we put a lot of effort to education, and all our new clients and existing clients, we provide a series of webinars, and we see that we understand that our clients are experts in investing, we are experts in hedging, and trying to combine together, work together to disperse as much as we can. As I said, there are different sectors, got the different challenges: housing, energy, microfinance, SME, and you can say each of them has a different challenges in terms of a tenor, in terms of the markets, collaterals, and stuff. So we go one by one, transaction by transaction, and very personalized webinars when we when we try to explain the mechanism of the hedging, what we do, how we do it, and help as much as we can to make this investment.
Thank you, Paul. And Jerry, coming to you finally, we understand that water equity also has a diversified investment strategy in that you invest in retail and SME or infra sector, or in other words, in retail, you provide loans for household access and for infrastructure that's related to WASH. So I think you're also at a good vantage point to understand sort of and assess the impact of these macro headwinds and how that sort of differently impacts retail customers as opposed to SME or commercial customers. It'll be great to understand from your experience how your sort of risk assessment and management has sort of evolved in these times that we are in across these two different streams.
Okay, thank you for your question. Yeah, the challenges are very different when you look at both aspects. So on the retail side, because these are households where their need is really for local currency funding, but when they reach out to the financial institutions, the interest rates are quite high. Now, that still remains a challenge, especially like I was listening to what Powell said, in Ghana with what the macroeconomic environment looks like, in Kenya, currency depreciation. So we're trying to work quite a lot with the financial institutions to be able for them to still have appetite to lend to this segment, especially because some are even focusing more on investing in risk-free assets. One of the key solutions is really to now start looking at, smaller ticket sizes or tranched kind of disbursements, shorter tenors, just to mitigate the current risks. Now, on the SME and infrastructure side, as much as this still remains a challenge, now for them, they still have an advantage in the sense that some of these SMEs have like hard currency cash flows, so they're able to quickly adapt to the challenges. But of course, they're still hit quite hard compared to what a retail borrower would have. And it's still the same case that we see on the infrastructure side. So here we look at different types of solutions, but mostly focusing on portfolio guarantee mechanisms, or even through also hedging solutions, where we would then reach out to partners who can provide such solutions to mitigate this risk.
Thank you, Jerry. Great. I think that sort of brings us to the audience Q&A session. And as I mentioned, we did receive a few different questions during the registration, and I do see a question on the chat as well. I urge the participants to send across any other questions as well. But starting off with one of the questions that we already received, which was on, so what's the scenario of local private capital mobilization in emerging countries with sort of depleting or flattening foreign assistance and foreign aid or foreign capital that's coming in these times? I'll take a quick shot at answering this question, but Christian, I'll look to your sort of insights working with some of these local banks as well. Conventional wisdom says that as foreign capital sort of the growth of foreign capital sort of dries out, both in terms of aid and foreign direct investments, most commonly domestic capital is on a slower pace as well. However, there have been several recent studies that isn't always the case. There are a lot of low-income countries where domestic capital has significantly grown despite there not being enough foreign capital. But in most cases, that's a result or it's correlated to more protectionist local regulations that doesn't allow for a lot of foreign capital to come in. But in most cases, yes, I think, as foreign capital risks increase and there's lesser foreign capital coming in, there's also lesser private capital domestically available for developmental objectives. That's indeed the scenario. But Christian, more from being on the ground, and I think you're every other month in one country or the other in sub-Saharan Africa. So it'll be great to hear from your perspective as to, in this current environment, how have the local banks grown, reacted? Are they holding their strings tighter or really going out there and sort of growing and diversifying?
Thanks, Arun. I think it's really diverse. You have to really look at the countries. Yeah, I mean, Pavel also mentioned Ghana before, and I think there's a particular situation in Ghana where before the crisis, before the default, all the banks just invested to government loans and not really doing lending. On the other hand, I must say I see countries that are LDC countries or low and middle income countries where very often a really nice, attractive SME loan does attract also local banks. Yeah? So when we analyze a loan here at Bamboo, for example, and see that it makes economic sense, you can be sure that 2 or 3 local banks are bidding against you. Yeah? So there seems to be capital available for these loans. Of course, it's never as much as anybody wanted. There's still a lot of risk capital that's missing, and there's still a lot of concerns around yields, because even the local pension funds, even the local social security needs to make their minimum returns and can't necessarily dedicate to a pure subsidized impact investment. But other than that, I would say it really depends country to country. We see some interesting developments in Tanzania recently, where apparently the new government tries to bring Tanzania back to the international investor community. We saw some struggles in Nigeria, of course, in Ghana, and we see a very open environment in Rwanda right now. But it's really country by country dependent.
Thank you, Christian. Maybe a follow-up question that we received on the chat right now, which is also linked to Christian, your earlier point regarding the local financial institutions being more competitive. The question is, most local banks are considered to be expensive, and most companies look abroad for better interest rates. Do you have any quick comment on that? Yeah.
Unless it's subsidized, I mean, look, there are a couple of impact investor players out there who are, using a casual expression, who are throwing out their money currently. I'm sure that some of us have experienced that as well. But local banks, I mean, look, again, they are looking at actually the right prices that they should price. Yeah? And unfortunately, different to Amy's experience so far, we don't have a long track record, but we can show that over the long run, we really have a significant yield. We still see quite significant risks in there, and we still see subsidized rates. What would help, of course, in that whole environment is really opening up this whole idea of venture debt or venture capital or mezzanine debt, where you could charge lower rates but have an upside as well. But other than that, I must say the local banks are, for those loans that are attractive, reasonably fair. Yeah? Obviously, if you come in with no lending experience and want a $500,000 loan for 5 years for your capex project, that's a challenge. But honestly, I would have the same challenge if I go to my bank in New York asking that.
And maybe sorry to interrupt, but maybe
Sure.
for a little bit more context to paint that picture as well as a note, our average ticket sizes do begin at 10 million and we can go up to 30 million. So it is a slightly different market. And there, I absolutely agree. The local banks are there, and they are most likely the most affordable option when you take into account the currency risk that you would take on board. So if you were to hedge that exposure, our pricing would theoretically would oftentimes be unattractive comparatively to local banks. Where the value comes from our perspective is we can invest and be financing partners in situations where the local banks are not interested. And what we do see is that in many of these markets, in Asia perhaps, they have quite stringent requirements around collateral, personal guarantees, and the leverage levels are not what you would have been able to find comfortable in the developed market. So we do take a bit more of a lever approach when it comes to these markets comparatively to what the local market is comfortable with. Furthermore, different to certain impact investors, we have actually to date not worked with developmental finance institutions as our investors. Our investor base is private. As a result, the restrictions on our our capital on our investment funds are a bit looser at times. And when I say looser, I don't mean in regards to ESG rigor, all of that we're trying to maintain best practice, but we can work in situations which are typically not considered additional within impact investors, such as recapitalizations, management buyouts, etc., which also local banks oftentimes have an issue with. From our perspective, and this can be a topic of another discussion panel, but we do consider that nonetheless to be impact driven because we're helping to catalyze an efficient capital markets for these types of emerging businesses that still need to grow, even if it's not in the traditional impact world considered primary capital for growth.
Thank you, Amy, for that additional context. That's really, really helpful. I think in the interest of time, we'll take one other question, which is there in the chat from Paul as to are there any sectors that are more exposed than others? And I think we received a similar question during the registration as to do investors now sort of prioritize one sector over the other based on the risk considerations in the current environment? Amy, I'll probably call upon you to answer that question, but anyone else who have additional context to add, please feel free to.
Maybe as an impact investor, you can't just flee when things get a little bit tough. So our perspective is it's about balance. And there are different opportunities which you lean in harder and heavier in certain environments versus others. And in our case right now, I will admit this is not specifically about sectors per se, but business models. We are trying to balance out the currency risk exposure within our portfolio because even though the portfolio is fully hedged to USD, the reality is the underlying businesses, they're taking on currency risk, they're hedging it, and their revenues and cost streams need to be aligned. So we are right now we have carved out a portion of our portfolio that is trying to find investment opportunity where the cost and the revenue line aligns, which could be slightly different structures. This happens in emerging markets in some sort of tourism. Can we get comfortable with tourism? Can we get comfortable with mining? Absolutely not. Can we get comfortable with production of something? Yes, then what type of production is it? And that's the thesis and the relative value analysis that we're going through right now as well too. Regarding areas that we're a bit more cautious on, perhaps actually no. I mean, everything else is generally pretty risky nonetheless, so we're lenders all here. Everything keeps us up at night.
Thank you, Amy. Of course, it takes a village to create the comprehensive impact, and it's difficult to significantly prioritize one sector or the other. And these difficult times keep coming time and again. It's a different cycle all over it. Great. That brings us to the 1 hour mark. And I would like to thank all the participants and especially our panelists who brought together a lively discussion. And thank you for their great insights. And the participants for the great set of questions as well. As mentioned, this is the second webinar in our webinar series, Reimagining Private Capital for SDGs, and we look forward to seeing you in our future sessions as well. In our first 2 webinars, we discussed the opportunities and trends and the risks and challenges in investing in underinvested sectors and geographies. And in our next 3 webinars, we'll throw spotlight on specific investment themes, starting with our next webinar on gender lens investing. It's tentatively scheduled for end September, early October, and please look out for our emails and our webinar series page for updates on this webinar. And as someone asked on the chat window, yes, we will have the recording of this webinar posted on the webinar series page in a couple of days' time, and you will have access to that. Great. Thank you very much again to all of you, and have a great rest of the day and evening. Thank you.
Thank you, everyone.
Thank you.
Thanks all. Bye. Thank you for organizing. Bye.